Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Something strange is happening in the financial world. Something most investors are completely blind to. They think the market is fragile, exhausted, maybe even doomed to fall apart. After years of turbulence, they believe the worst is still ahead, that caution is the only rational stance, that optimism is reckless, and yet, quietly, behind the noise, the foundations of the next major market rebound may already be forming. But unless you know where to look, you won't see it. In fact, you might do the worst thing at the worst possible time: stay on the sidelines while the rebound of the decade unfolds right in front of you. The signals aren't loud. They never are. They hide inside contradictions, falling indicators that somehow strengthen the economy, fearful sentiment that historically precedes explosive upside, institutional moves that look conservative on the surface but reveal long-term bullish confidence beneath. And all of it points to one conclusion: a massive rebound may be far closer and far larger than most people expect. But to understand why, you need the backstory. Because this moment isn't new. It's part of a pattern that has repeated for decades, sometimes centuries. The same forces that once fueled the recovery after the dot-com crash, the rebound after the great financial crisis, and the rally that blindsided analysts in 2020 are resurfacing again. This isn't a prediction from thin air. It's a chain reaction set in motion years ago. A story with origins, turning points, villains, warnings, and consequences. And if you follow that story step by step, it becomes almost impossible to ignore the conclusion. Today's fear may be the foundation of tomorrow's rally, but to see the future clearly, we need to go back to the beginning. It starts with a belief, the belief that markets move based on today's headlines. Investors scan the news, hear about inflation, interest rates, geopolitics, elections, layoffs, supply chain shocks, and assume the market must follow the emotional tone of the moment. But markets rarely move because of what everyone already knows. They move because of what's changing underneath the surface, long before the public understands the shift. Every major rebound in history began not with confidence, but with confusion. Not with good news, but with conflicting news. Not with certainty, but with tension. To understand the current moment, picture the late 1970s, an era of chaos. Inflation was spiraling. Oil prices were unpredictable. Interest rates were weaponized like sledgehammers. Pessimism was so normalized that optimism looked irrational. And yet, hidden beneath fear, a turning point was forming. Productivity was bottoming. Capital investment was quietly returning. New technologies were being adopted behind the scenes. Public sentiment was deeply bearish, in fact. And when the shift finally came, it came violently. Those who bought into fear missed the massive bull run that defined the next decades. Fast forward to the year 2000. The tech bubble had burst, wiping out trillions of dollars of paper wealth. Retail investors swore off stocks. Analysts predicted a lost decade. But what they didn't see was the steady build-up of infrastructure, early broadband, foundational software, global supply chain modernization. The rebound didn't come because the news got better. It came because the fundamentals quietly reset while the public was too traumatized to notice. Fear produced discounted prices. Discounted prices attracted capital. Capital fueled innovation. And innovation drove the next cycle. Then 2008 arrived, the great financial crisis. Banks collapsed, credit froze, markets crashed. It was the closest the system had ever come to stopping completely. But while fear consumed the surface, something else was forming underneath. New regulations, stronger capitalization, safer lending standards, massive liquidity support, and a wave of technological adoption accelerated by necessity. Once again, fear created the opportunity. And those who saw beyond the panic saw their portfolios multiply in the years that followed. Even in 2020, during the global shutdown, when markets fell harder and faster than almost any moment in history, the same pattern emerged, while fear reached levels unseen in decades. A tsunami of liquidity, technological acceleration, and behavioral shifts set the stage for one of the sharpest rebounds the world had ever witnessed. So here's the uncomfortable truth. Major rebounds rarely begin when things look good. They begin when things look slightly off, when the data is mixed, not clear, when the news is loud but disconnected from what's happening beneath. And today's financial environment fits that description almost perfectly. Look at what's happening right now. Inflation is coming down, but spending remains strong. Unemployment is low, yet companies are quietly restructuring. Rates are high, yet corporate profits are improving. Housing affordability is terrible, but construction demand is rising. Bond markets are signaling caution, while equity markets are showing resilience. And investor sentiment? It's stuck in a strange mix of fear, cynicism, and disbelief. The exact sentiment that historically precedes powerful recoveries. But here's where the story gets even more interesting. Because the current moment isn't just repeating history, it's amplifying it. Several structural forces are converging at the same time, creating conditions that could lead to an unexpectedly strong rebound. Let's break down the chain reaction forming quietly beneath today's uncertainty. The first force is liquidity. Central banks spent years tightening, but now, for the first time in a long time, the world is preparing for a shift. It's not just one country. Multiple major economies are signaling easing cycles. Liquidity doesn't appear instantly. It builds like pressure inside a valve. By the time it shows up in headlines, the market has already priced in the next move. Today, early signals are flashing. Bond yields softening, credit spreads narrowing, money supply stabilizing. These aren't signs of collapse. They're signs of preparation. The second force is corporate efficiency. Years of economic pressure forced companies to optimize aggressively. Layoffs weren't just cost-cutting. They were resets. Automation, AI integration, productivity tools, and leaner structures created companies that can now generate more profit with fewer resources. This shift is quiet but powerful. When efficiencies rise before demand recovers, earnings can surge faster than expected, leading to explosive stock performance. The third force is innovation infrastructure. Unlike previous cycles, today's technologies aren't theories or prototypes. They're deployable. AI isn't speculative. It's being integrated across industries. Green energy isn't conceptual. It's scaling. Robotics isn't experimental. It's commercializing. Cloud computing, cybersecurity, biotech, materials science, all have matured to the point where small improvements lead to exponential economic leverage. And historically, major rebounds align with moments where innovation infrastructure is ready for mass adoption. The fourth force is behavioral. Retail investors are exhausted. Institutions are cautious. Hedge funds are hedged to the teeth. Sentiment is skeptical, defensive, even somewhat depressed. But extreme pessimism is a contrarian's compass. When the crowd is too afraid to buy, even small positive catalysts trigger oversized upward moves. That's why some of the biggest rallies in history happened during periods of widespread doubt. Finally, the fifth force is valuation. Not everything is cheap, but pockets of the market are deeply discounted relative to historical averages. Small caps, certain sectors of tech, international markets, cyclical industries that overcorrected out of fear. These areas are loaded with pent-up potential, waiting for capital rotation. So what does all of this mean? It means the ingredients for a significant rebound are already in place. And that rebound doesn't need perfect conditions. It only needs momentum, the tipping point where fear gives way to curiosity. Curiosity gives way to participation. And participation gives way to conviction. But let's take this further. The market doesn't move in straight lines. It moves in stories, cycles of cause and effect. And right now, the story developing beneath the surface looks eerily familiar. Consider this. Nearly every major market bottom in the last 50 years shared three characteristics. First, pessimistic sentiment persisted despite improving fundamentals. Second, liquidity subtly shifted before the public noticed. Third, early data signals contradicted mainstream belief. All three are happening right now. But here's where the twist comes in. People assume that markets rebound because things get better. But in reality, markets rebound because things stop getting worse at the same pace. The rebound begins before the narrative changes. And that's exactly the setup we're seeing today. But let us step back and follow the modern chain of events chronologically, because the story becomes even clearer when viewed as a sequence. It begins with the post-pandemic inflation crisis. Trillions of dollars flowed into the system. Supply chains were disrupted. Demand exploded. Prices surged. Central banks panicked and raised rates aggressively. Markets fell. Confidence deteriorated. The cycle reset. Then came the stabilization phase. Inflation began cooling. Supply chains normalized. The frantic rate hikes paused. Markets found footing, but sentiment didn't improve. Instead, fear remained high. Analysts issued warnings. Headlines focused on risk. Investors stayed defensive. Next came the quiet accumulation phase. The phase that most people never see until it's too late. Institutions began positioning slowly. Bonds adjusted. Corporations deleveraged. Consumer savings stabilized. But because the news remained negative, few noticed. Now we're entering the early ignition phase, the stage where catalysts begin appearing one by one, easing inflation, improving earnings, resilient employment, renewed liquidity signals, and rising investment in innovation. Historically, this phase precedes breakouts. And if the pattern holds, the next phase is acceleration, the moment where markets surge. Sentiment flips from disbelief to FOMO, and those sitting on the sidelines realize they underestimated the power of cycles. But the danger isn't just missing the rebound, it's misunderstanding it. Because when rebounds come from deep pessimism, they tend to be sharper, faster, and more powerful than most people expect. That's why this moment matters. The contradiction between fear and fundamentals is widening, and markets respond violently when contradictions resolve. But this isn't a guarantee. Nothing in markets ever is. There are risks. There are geopolitical uncertainties, technological disruptions, political tensions, and global rebalancing forces. But throughout history, every rebound was born during periods where risks were obvious and opportunities were hidden. And we are standing in exactly that environment today. So what does the individual investor do? You don't predict the future. You prepare for scenarios. And this scenario, a powerful rebound built on improving fundamentals, misunderstood signals, and historical patterns, is one you cannot ignore. Before we close, here are 3 takeaways to anchor this moment. First, fear distorts perception. When headlines are loud, investors see only danger. But markets don't move on fear. They move on change. And the changes happening now are quietly bullish. Second, rebounds begin invisibly. They start in the data, not the news. They start in shifting liquidity, rising efficiency, and unseen accumulation. And those shifts have already begun. Third, cycles repeat because human behavior repeats. Panic. Denial. Realization. Accumulation. Rally. If you understand the cycle, you stop reacting emotionally and start thinking strategically. But here is the warning. If you only follow the emotional tone of the moment, you will always enter late and exit early. The biggest opportunities appear when clarity is low but change is accelerating. As you watch the markets over the next few months, pay close attention not to the noise, but to the pattern. Because if history continues to rhyme, and it usually does, the next major market rebound may already be unfolding beneath the surface. If you found this breakdown valuable and want deeper insights into market cycles, hidden catalysts, and the signals that most investors overlook, make sure to like the video, subscribe for more weekly analysis, and share your thoughts in the comments. The next chapter of this story is just beginning, and you don't want to miss what comes next.